If a reverse mortgage gives you an uneasy feeling, you're not alone. There's a ton of marketing about this. So let's cover this in the simplest way possible: what it is, how it works, who's a good fit for it. Hi, I'm Tara. I help Utah homeowners make mortgage decisions with hopefully their eyes open. And today we're going to cover reverse mortgage and just go over the basics. The reverse mortgage is opposite of a traditional mortgage. A traditional mortgage, you borrow money to buy the house, you make monthly payments every month, and your loan balance goes down over time. The reverse mortgage is basically the opposite of that. Whatever money you borrow, you are not required to make payments on it. However, you can make payments, and the balance of the loan increases over time. So it's a very, very simple way to explain these. Qualifications are different, however, they're more based on your age, how much equity you have in the home, and they do go over a few basic assessments to make sure you are able to maintain the property, take care of your property taxes, insurance, HOA dues, maintenance, all those kind of the basics or to cover those basic expenses of the home. So who is a reverse mortgage for? It's for homeowners over the age of 62. There are some other loan products, proprietary products for people who are 55 and up, but a general reverse mortgage requires you to be 62 or older. People who can benefit are the people who plan on staying in the home for the long term, have a lot of equity that they want to tap into, and want some flexibility on how you handle your retirement. So the most common way to use a reverse mortgage is to refi your current home and tap into that equity. You can receive that money in a few different ways. You can receive a big lump sum, like you're going to do like a cash out refi. You can actually receive a monthly stipend. You can set up a line of credit, which is a whole video in and of itself, or you can do a combo of all of those. So you can there's a lot of options on how you access this money if you're taking cash out. So I touched on this a little bit, the requirements of the reverse mortgage. This is where people get confused. There are still requirements of the reverse mortgage, even though you're not qualifying for them like a traditional loan. So you're required to live in it as your primary residence, pay your property taxes, pay your homeowner's insurance on time, and any HOA dues, if you have HOA dues, those have to be paid and maintain the home. If you fail to do any or all of those things, they can foreclose on you. So they call a reverse mortgage a non-recourse loan because they aren't going to foreclose on you if you don't make payments. That's the whole benefit of the loan, but you still can be foreclosed on you. So a lot of people don't understand that. You still own the home. They put a lien on the property just like a traditional loan. Just the balance is increasing over time, or the balance can increase over time. So how does this loan get paid back? You can make payments if you choose to. So sometimes people will pay maybe like an interest-only payment, or sometimes people who get really creative will pay like a lump sum towards the balance every year or every few years, and they kind of play that game with their income taxes. But usually the loan gets paid back when the home is sold. So whether you want to move, you pass away, or you have to go live in a retirement home, bottom line, if you can't live in it in your primary residence, or you choose not to live in it as your primary residence anymore, then they will require you to pay the loan back. So you can sell the home, just like any home with a normal lien on it. Whatever your equity, whichever equity you have is how much you will make. When you sell the home, you'll make the proceeds. You get the proceeds just like you would on any home you own with a loan on it. You can actually pay the loan off. If you say you win the lottery, you don't want to do it anymore, you can pay that off. Or you can refinance it into a traditional loan. That sometimes becomes harder depending on how much equity you have in the property, but you don't have to keep it. You're not stuck with it. So let's say you are the heirs of the property. You still go and sell the home just like you normally would, or if one of the children want to keep the home, they can refinance the home into their own names, just like, again, any loan with, or any home with any other mortgage on it. However much you sell it for, you subtract out your fees of selling, subtract out the balance of the loan, that's your profit. You can go and divide that up amongst the estate. One thing you should understand is you do have some time restrictions on that, so they do want to see that you have listed the home quickly, and you will get a bunch of stuff in the mail. That, just so you know, they are pretty flexible with you. They want to see that the home is listed. One other benefit to the heirs is, let's say the home is upside down in the value, but they want to keep the home. Part of the benefit of having a reverse mortgage is the estate, if they want to keep the home, they only have to pay 95% of whatever the value is of the home. So that's where if it's the FHA version of, that's where having the FHA insured version of a reverse mortgage comes in. There are proprietary reverse mortgages that other companies have created that also follow that same guideline from FHA. So if the heirs take over the home and it is upside down in the value, they will never pay more than it's worth. Hopefully that clears up just some of the basics. We'll do more videos about we'll go into more deep dive on these, cover some more topics. Reverse mortgages are not good or bad. They're just like any loan. If it fits for what you need, it can be a great option for you. So shoot me a comment if you have any questions. If you want to chat about reverse mortgage, I'm happy to run numbers for you, and we'll catch you on the next video.